Hey guys, welcome back to Kiwoon Learning, and today we're going to be talking about advanced metrics for value investing. Now as you can see from the back, things are a little different because with the snap of my fingers, I'm in a classroom. I'm in your closet. I'm hiding under your bed. Now we're going to be talking about three different metrics in this video. The free cash flow, the beta, and the return on equity. So let's get started. This video is the second of two videos. We made an initial one, which was the basic metrics of value investing. So if you haven't watched that one, go ahead and watch that video first. So diving right into things, let's talk about free cash flow. Now, free cash flow is in its name. It's free cash that's in a flow. Free cash flow is the money that is left over after a company takes away all their operational costs from their revenue. Now this is free cash that they can use for anything they want. Companies use free cash flow in order to pay off their debts, or maybe make acquisitions, or they can give out dividends to their investors, or even make new products. All of these things are things that help a company make more money, which then also helps investors make more money. So this is why free cash flow is so important for long-term investing and determining whether a company is a good investment or maybe not so much of a good investment. I talked a little bit about what a company could do with their free cash flow, but let's get a little bit more into the nitty-gritty about them. The first one is dividends. Now what is a dividend? A dividend is when a company takes their surplus of profits and they divide it by the number of shares outstanding so that each investor has a little bit of profit. Now this is just a way for a company to say thank you. It's a little bit of money. Another thing that a company can do is buy back their shares.
But why would a company want to buy back their own shares?
Great question. The reason why a company wants to buy back their own shares is because it drives up the price of the stock. Now the reason being is if you take a big number and you divide it by a large number, and then you divide it by a smaller number, you get a larger number from the number that you divided with a smaller number. Now this is the same concept. If they buy back their own shares, they're reducing the number of shares that is out for the public. So this drives up the stock price. This is great for investors because they're making money. The stock price goes up and they make money. But this can be a problem if they are over their estimated price target. This is because if they're over the estimated price target and they increase their shares up even more, that means that it has more to drop. Now if it's under, this just gives it a little bit of a boost, a little nitro, and it helps bring up that price and it's great for everyone. Another thing that a company can do with their free cash flow is
reinvesting into the company.
Now the reason for this is quite simple. Let me give you an example. Let's say a company makes chicken and they see the future of AI and they believe that they need to make a change. So they decide to make
robot chickens.
But they can't do this without any money. Well, here comes free cash flow to the rescue. They use that free cash flow in order to reinvest into their company, make new templates, make new factories, different things to establish that robot chicken and give people the taste of the future. Now another thing that a company can do with their free cash flow is paying off their debt. Now when a company pays off their debt, they are reducing their debt. And finally, a company can make acquisitions. Now a really good example of an acquisition was Now an acquisition is when a company uses their money to buy another company in order to make them more profit. Now a great example of this is that T-Mobile recently bought Sprint for almost $30 billion. Now this may seem like a huge amount for the company to buy, but in the long run, this will help them make even more profit and it established them as a huge networking company. So I want to show you guys how to find the free cash flow. So I look up free cash flow Alibaba just for an example. You can do any other company. But I scroll down and I find MarketWatch. I personally really enjoy MarketWatch, so I think they're very clear. So I click it, and yeah, here we go. And I scroll all the way down to the bottom, and then you can see that there is free cash flow. You can see Alibaba has $151.7 billion of free cash flow, which means that they're a very healthy company. Now let's talk about the next metric. Now what exactly is beta? Well, beta is used to measure a stock's volatility and it can help you determine your portfolio's volatility. If you didn't know, volatility just tells you how much a price of a stock can go up or down. So basically beta just tells you how much of a risk your stock is compared to the overall stock market. Beta is really crucial when you're trying to diversify your portfolio or make your portfolio less volatile. And this is because beta can tell you whether a stock is very volatile or not so volatile, so you can find a good mix. But let's talk numbers. In number terms, when the beta is equal to 1, this means that the volatile and general trend is equal to the general stock market. Now, if it's closer to 0, this means that the stock is even safer, has less volatility than the stock market. Now, if it's greater than 1, this is when there's more volatility. How do you find your portfolio's beta? Well, you do this by taking the percentage a stock has in your portfolio, then multiplying that by the corresponding stock's beta. Then you add those all together for each stock that you have, and then this will get you the total number of beta in your whole entire portfolio. Let me give you an example. Let's say that you decided to invest in the 4 stocks we talked about this past month. So you decided to divide your portfolio amongst these 4 stocks equally. The 4 stocks we talked about are Regeneron Pharmaceuticals, Perion Networks, USA Truck, and Helicity. So now Regeneron Pharmaceuticals has a beta of 0.14. Perion Networks has a beta of 1.03. USA Truck has a beta value of 2.29, and Helicity has a beta value of 0.75. Now, because you equally divided your portfolio amongst these 4 stocks, your percentage would be 25%. So you would multiply the beta by 0.25. So it would be 0.14 times 0.25 plus 1.03 times 0.25 plus 2.29 times 0.25, and then finally plus 0.75 times 0.25. And then this will give you your portfolio's beta value, which is equivalent to 1.053. What this means in context is that your stock portfolio is 5.3% more volatile than the overall stock market. Now, this is because you take your 1.053 and you subtract it by 1, and then you get 0.053. So to convert that into decimal, you move it 2 places and you get 5.3%. Here's the thing with high volatility. High volatility isn't always bad, because despite the fact that a stock could plummet with high volatility, it can also go up with high volatility. And finally, because you made it all the way to the end of this video, you get to learn about one of the most important metrics in value investing. The return on equity, also known as the ROE, is really important because it tells an investor how well a company can make money without spending tons of money. So maybe you can make $1 billion in a year, but another company spends $100 billion to make $1 billion, and another company spends $1 million to make $1 billion. But what exactly goes into the return on equity? Well, the first thing you have to understand is, what exactly is equity? There is a formula for finding the equity, and that is by using the total assets of a company, which equals the liabilities plus the equity. Now, the total assets are the buildings, the transportations, different stuff like that. And the liabilities are loans and mortgages. So when you have a company maybe has $500,000 worth of buildings and transportation, but they decided to take a loan of $300,000. Well, that leaves total net equity of $200,000. So this is what the company has on hand, what they paid for with their own cash. Now that we know what equity is, let's return back to the return on equity formula. Now, the return on equity is found by taking the net annual income and then dividing that by the equity, as we talked about. The goal of the return on equity is to have a higher percentage. So this means that you want higher net income annually, but then you also want lower equity, because as we talked about, this means that a company is able to make more money without spending a crazy amount of money. A good ROE is between 15 and 20%, and this is because this means that a company is pretty good at making money. Now, something to understand is that companies have to be compared with other companies in the same category, similar to the PBT ratio. Now, this is because you don't want to be comparing some industry with something like Facebook, and this is because industries require lots of money to the big machines and the big buildings in order to make a profit. Compared to Facebook, they don't really need to spend too much money in order to make a profit. So you have to compare them amongst companies in the same category. Another thing that should be taken into consideration is to match the ROE with the price to book ratio, which is something we learned in the previous video. This is because the price to book ratio tells you whether a company is overvalued or undervalued. And this is because it takes the valuated price of a company and it divides it by the total number of assets that it has. Now, in comparison with the return on equity, let's say that the PBT ratio is very high and the return on equity was very low. This means that the price of the company is very high compared to their assets, yet they're not making a lot of money from their assets. And this is a terrible disaster. The P/B ratio and the return on equity should be moving in unison. So if the P/B ratio is going up, so should the return on equity, and vice versa. I want to finish this off by giving you an example. Let's say there are two companies, Company A and Company B. Company A has a net equity of $100 million, and Company B has a net equity of $50 million. Now, both of these companies made $10 million this year. So the first thing we want to do is we want to take the $10 million and divide it by the $100 million or the $50 million. And what we get is that Company B has a higher return on equity, which is 20% compared to the 10%. and this indicates that company B is better at making money with less money. I understand that the return on equity sounds like a very golden metric, but it's just a metric. You have to understand that you have to use the return on equity with other metrics so you have a better understanding of how a company is. That wraps it up for this video. I really hope you guys enjoyed it, and I really hope you guys learned something new. We learned some very great metrics that will help you boost your investing knowledge. So if you have any questions, feel free to leave any comments. Make sure to like and subscribe, and peace.
Thank you.